Okay, so good morning or afternoon to you all. It is the afternoon on my end. My name is Rollins Ayaya, and I'm a master's candidate in finance at the University of the Witwatersrand, which is located in Johannesburg, South Africa. I'll be presenting this paper, which I co-authored with my partner and classmate Ranchin Vin, and he was the math genius behind the empirical study. So just a brief background. There has been quite a bit of research on long-run reversals. However, the study was heavily focused on US and European equity markets. One of our recent examples being Garcia Fajon Jensen, whose paper was a build-up from the famous Farmer and French of 1996. They are two of the key authors who our paper was inspired, along with many others. There's evidence of reversals around the world for various reasons, such as overreaction, but this paper specifically looks at the impact of monetary policy effects on long-run reversals. So we'll look at two monetary environments known as the expansionary and restrictive. And expansive monetary policy occurs when the central bank aims to stimulate economic growth by lowering short-term interest rates and expanding the money supply of a country. On the contrary, restrictive monetary policy occurs when the central bank aims to combat inflation by raising short-term interest and limiting the money supply of the country. So now that we have a brief understanding of the research background, I will now walk you through what's the purpose of the paper by asking what's the aim. And that is to determine if monetary policies impact long-run reversals in South Africa. Okay. And yeah, so now we'll be going over the literature review. So as mentioned earlier, Garcia Fajon Jensen is the inspiration of this empirical study. They performed an incredibly similar study of Mr. Lin and I, but they focused primarily on US markets. And the study was an extension of Farmer French of 1996. And then in South Africa, there have been studies in long-run reversals by gentlemen such as Page and Way and Orator Britton and Page, who are actually my professors. So, but however, none of these authors took monetary conditions into account. Page and Way, for an example, theorized that overreaction played a role in long-run reversals. And then lastly, we'll look at Blackburn and Kaki and Zaremba. Blackburn focused on primarily North American, European, and Asian markets, and Zaremba looked at through about 74 countries in his empirical study. So there have been a number of theories as to why long-run reversals occur, and they include what we see in the title row of this slide, right? So the theories are overreaction, monetary conditions, firm characteristics, the January anomaly, and momentum theory. So I'll briefly go over the table and explain the theories and findings. So personally, I found de Bont and Thaler's findings and suggestions pretty interesting. One could say that they're the leading authors who examined overreaction in equity markets. And they use equally weighted monthly return data from the New York Stock Exchange between 1926 and 82, and concluded that in the US market, shares with a prolonged period of poor performance somehow end up outperforming the winners by an average of 31%. And de Bont suggested that this was due to overreaction because investors became overly pessimistic about stocks that performed poorly and overly optimistic about stocks that exhibited superior performance. And then we have Page and Way, who examined reversals in South Africa, and they found that on average, the portfolios of prior losers outperformed the winners by about 20% after a 3-year horizon. Then we look at monetary conditions, Joyland and Latemo. They reported a relationship between interest rates and shocks to stock prices in the United States. And Garcia, Fajon, Jensen support this theory because of how the monetary policy changes affect the US share prices. And then we look at firm characteristics, which just speaks about how where Garcia, Fager, and Jensen found that characteristics such as size, firm beta, book to market equity ratios play a role in reversals. And then we look at the January anomaly, where the month of January is known to have a significant effect on share prices, but finance authors are yet to determine why, hence why it's called an anomaly, even to this very day. And then lastly, with momentum theory, which is defined as when security prices are experiencing changes at a pretty rapid rate and continue with these changes. And it was found that by these authors that that investor behavioral bias that causes short-term momentum is the same as the one that causes long-run reversals. Okay, cool. So now we'll be looking at the methodology. My partner, Ranchandlen, was the spearhead, the math whiz of the empirical section. And yeah, so I'll start off with the sampling and data collection. The period ranged from January 2000 to December 2019. Why from the year 2000? Well, because the South African Reserve Bank's monetary policy framework changed to inflation targeting. Our firm sample was 458, and the proxy for the risk-free rate was the 91-day Treasury bill of the South African Reserve Bank, and the benchmark returns was from the JSE index. And then we ask ourselves, how do we define and build the small minus big and high minus low portfolios? And to put it simply, we divided all shares into two groups, big and small size, and we compared them to the median. If the market of the shares was greater than the median, they were placed in the big group, smaller than the median, they were placed in the small size group. And then we further divided them into high, medium, and low groups. And why the median instead of the mean? That's because the JSE top 40 makes up over 90% of the market cap in the JSE All Share. And then we look at how do we define the winners and losers. We, just like Garcia, Fage, and Jensen, we split the portfolio into quintiles. So the top 20% or the top fifth is the winner group, and then the losers are the bottom 20%. And then the next slide, we'll talk about how we define the monetary condition. So the changes of discount rates, so the changes of the discount rates will be viewed as shifts in the South African broad monetary policy. So now, if you look at this graph, for the periods that the discount rate is increasing, we argued that the monetary condition or environment is restrictive because the banks are raising the interest rates. And if they want to stimulate the economy, they'll lower the interest rates, hence an expansive monetary condition. And then, this was the analytical framework, these were the regression models, but since we're pressed for time, I won't really be walking you through them, but it is inspired by Garcia, Fage, and Jensen, a similar study. And then as for the results, before we dive and examine the monetary environment impact on long-run reversals, we first need to determine if reversals are evident in the sample, and then we'll look at the January effect. So, so table one reports the equally weighted average returns.
3 minutes left.
In quintiles. And then we can see in the top row that the shares are allocated into quintiles with the loser and the winner on either end. What you can find in this row here that the losers failed to outperform the winners by 34 basis points, which just shows that the reversals are not that evident, unfortunately. And it did contrast our results or the results of the previous authors, such as the more recent one, Oret, Britton, and Page of 2016, who reported reversals. And then what we did here is that we examined the January effect. So this panel looks at the full sample data, and then panel B looks at January, excludes January because January is known to inflate the data for God knows why. And then, so in panel A, we can see that the losers failed to rebound, exhibiting a negative 40 basis points. But then if you exclude January, it's actually a lot worse with a negative 58 basis points drop. And then we look at the monetary environment's impact. So what we see here is that the loser minus winner returns. Yeah, so we see, look at the loser minus winner returns during both expansive and restrictive periods. And we can see that the losers fail to rebound or to beat the winner, exhibiting a negative 62 basis points drop. But however, in the restrictive period, interestingly enough, the losers do close the gap. And then as we can see in this graph, it does support table 3, where we can see that the losers consistently perform worse than the winners, and they're not reversing at any point except for during the 2008 financial crisis. But then afterwards, they exhibit a poorer performance. And then lastly, we look at table 4, which is an expansion of table 2. And what we can see here is that the losers still fail to, under expansive and restrictive conditions, the losers still fail to produce superior returns compared to the winner, even if we exclude January. In fact, they even perform much worse if you compare these two numbers. And then, but however, from the expansive to restrictive conditions, the loser portfolios or the loser firms tend to close the gap, right? And then, yeah, so to wrap up this presentation, we looked at the aim of the study by asking, we looked at the purpose of the aim of the study by asking if the monetary conditions do have an impact on share reversals during the expansive and the restrictive conditions, which I've explained earlier. And then the results proved that, or suggested, should I say, that the losers failed to outperform the winners, which did oppose our hypothesis and also the more recent previous authors of South Africa that reversals were existent. But there were some limitations, and there may have been reasons why.
Thank you, Rollins. Can you just wrap up, please?
Oh, wrap up. Okay, thank you. Yeah. So there may have been reasons why, such as different sample periods, and then also the required the limitation of the empirical research was that a lot of firms did not have all the required data to do a full sample analysis, unfortunately. And then lastly, how we could improve or fill in the gaps is by examining or exploring various firm characteristics such as size and how it affects the long run reversals of firms in South Africa. Thank you.
Thank you.